Want to invest without stressing over stock charts or trying to time the market? Well, in this video, I'm going to show you how to build a diversified portfolio that basically runs itself and still helps you grow your wealth in the long term. Whether you're brand new or just tired of overcomplicating your portfolio, this strategy gives you solid growth, minimal maintenance, and most importantly, peace of mind. Let's start with this. Diversification isn't about owning 100 random stocks. It's about owning the right mix of assets so when one part of the market is down, another part keeps you balanced. Think of it just like building a plate of food. You don't want too much protein or too much carbs. A good portfolio has everything your money needs to stay healthy and grow. Now, one of the easiest and smartest ways to do this is something called the 3 fund portfolio. Here's what's in it. First, a total US stock market fund. This gives you exposure to so many American companies, from giants like Apple and Amazon to small businesses you've probably never even heard of. One of the most popular choices is VTI from Vanguard. It covers the entire US equity market, large cap, mid cap, and small cap stocks. Since its inception in 2001, VTI has returned an average of around 8 to 10% per year, including dividend reinvestments. Alternatives include SGHB from Schwab and ITOT from iShares, which both track similar indexes and have low expense ratios. Second, you add an international stock market fund. This takes your diversification global. Now you're not just betting on the US, but you're investing in companies across Europe, Asia, Latin America, and emerging markets all over the world. A topic here is VXUS from Vanguard, which holds over 7,000 international stocks. Since its launch in 2011, it's returned about 4 to 6% annually, which may not sound exciting, but it moves differently from the US market and helps reduce overall risk. Alternatives include IXUS from iShares or SCHF from Schwab. These also offer solid global exposure with low fees. Third, you include a total bond market fund. In simple terms, a bond is like an IOU. When you buy a bond, you're essentially lending money to a company or a government for a set amount of time. They promise to pay you back the original amount you lent plus interest at a later date. Buying a bond ETF through a brokerage gives you indirect exposure by owning shares of a fund that holds many bonds and they trade just like a stock. Bonds are lower risk than stocks and they tend to hold up better than stocks do when the stock market is struggling. A go-to is BND from Vanguard. It holds US government and investment grade corporate bonds. Over the past 10 years, it's returned an average of around 2 to 4% annually, depending on interest rate trends. You can also look at AGG from iShares or SCHG from Schwab, both of which have similar holdings and performance. A classic starting point for this kind of portfolio is 80% in stocks and 20% into bonds. That setup leans towards growth, but with a little bit of protection built in. Now, if you want help figuring out what's right for you, there's a simple guideline called the Rule of 100. What you do is you take 100 minus your age, and that number is roughly how much percent you want to be invested into stocks. So if you're 25, you might be around 75% stocks and 25% bonds. If you're 50, it could be 50-50. It's not a perfect formula, but it helps match your risk level to your time horizon. And the great thing is, you can tweak it based on your own personal comfort. If you're a bit more conservative, then most people your age bump up your bond percentage. If you're more aggressive and don't mind some of the ups and downs of the stock market, you can tilt it more towards stocks. And here's the best part. This strategy has been tested decade over decade. Through recessions and pandemics, you name it, it holds up. It doesn't try to predict what the market will do next, and that's exactly why it works. To get started, all you need is a brokerage account. Fidelity, Vanguard, Schwab, Robinhood. Any of those work. Search for ETFs like VTI for US stocks, VXUS for international, and BND for bonds. Set your percentage, invest a little each month, and watch your portfolio grow. Keep in mind, this isn't just a get rich quick scheme. This is a good way to set aside a portion of your income and allow the compounding of long-term wealth. If your US stocks start growing too fast and make up too much of your portfolio, you can tweak it, rebalance it, meaning you sell a little from what's grown and buy more of what's lagging behind. It keeps your risk level in check and your strategy consistent. I hope you guys enjoyed this video. This is my first video on this channel. So if you found value from it, drop a like, subscribe, and yeah, just let me know what you guys think, what you guys want to see in the future. I'll try to help as many people as I can, answer questions. Anyway, thanks for watching, and I'll see you in the next video.